So, good morning, everyone. I thought we start today with one or two articles from the Wall Street Journal of the last Saturday edition. So, now that we've kind of finished up our first intuition part, I kind of try to start every week with at least one article from a financial journal. So hopefully we can connect back to what we have learned and hopefully also learn something new. So here, I think is a very funny picture, since you know this sentence about don't put all of your eggs in one basket. So you have here one basket which is breaking and it has a big fat single egg in it. So the title of the article has been, yes, you have too much money in that one hot stock. So it has to do about diversification, and I think it's worth looking into that. So it says, even sophisticated institutions sometimes fall into the trap of putting an unhealthy number of investing eggs in one basket. I think the example they have in mind is the NVIDIA stock. So you kind of see NVIDIA, the share price on the left, around 2000 up to 2019, rather constant on that. It looks on that scale, and then since 2022, kind of price went somewhere from 20 up to 150, which is a clear outlier. So the article is about that. If you need to ask whether you have too much money in one investment, the answer is yes. So even after the latest tariff turmoil, stocks have mostly recovered their April losses. So readers, friends, and families are asking me questions like, is it a bad idea to have 85% of my portfolio in NVIDIA? Or they ask, should I own some other stocks beside Apple? Or they ask, if Bitcoin is 90% of my assets, should I scale back? Yeah, for something like 99.95% of people, the answer is yes. You should diversify more. Now, Warren Buffett and his late partner, Charlie Munger, have repeatedly said that diversification, spreading your bets across many stocks rather than focusing on a few, makes sense for most investors. Of course, they've also said that this does not apply to those with superior skills or knowledge like themselves. Now, we also talked about superior skills. We measure that by the alpha. Good. The problem is we all think we have superior skills when most of us don't. So that's interesting. There's really research supporting that. And we've also seen the statistics that on average an asset manager cannot beat the market, right? So there is no skill in that definition, skill being the alpha. Even sophisticated investors can fall into that trap. Just look at some private foundations, how they manage their fund and their money. So that's kind of interesting rule of thumbs for you. About 10% of the roughly 300 of these private foundations with more than 500 million in assets have at least 30% of their portfolio in a single stock. Okay. More than a dozen have at least 75% in only one stock. Okay. So you're not alone if you've got most or all of your money riding on a single concentrated bet. That can happen not only to skilled investors, but to anyone who has the good fortune to buy an asset that goes on to have spectacular returns, right? So the question is, you buy something, maybe 50-50 if you have two stocks, but one of the stocks is really rising. Now, in this Andrew Ng asset management book, he talks about you should still diversify, so sell the winners and keep buying the losers. If you don't do that, you will naturally have the tendency that this winner stock tends to dominate your portfolio. So it's a very natural thing to happen. So few stocks have performed better in recent years than NVIDIA. Consider what happened to Hen Sun and Lori Huang Foundation created by the NVIDIA's founders. As of 2019, the assets were 378 million. And then over the past 4 years, that value increased to 3.4 billion. Yeah, even after paying out more than blah, blah, blah. Okay, so that was thanks to NVIDIA's return of 750% over 4 years. So yeah, like 200% per year. Or take Lilly Endowment, the latest, they also have like 94% in the stock. Okay. Many other private charities whose assets once consisted primarily of a single stock, including the Ford, the Gates, and the Kresk foundations, have gone on to spread their investment bets more widely. Do the Huang and Lee foundations have any plans to diversify? Question marks. Spokespeople for two organizations declined to comment. But investors of all sizes should remember an old maxim: diversification is the best course of action at the very moment when it feels like the worst. So now comes an example where diversification paid off. Over the 10 years ended in 2019, VF Corporation, which makes clothing, generated a stellar 29 annualized return, outpacing the S&P, which at that time earned 13%. At that point, the investment portfolio consisted almost entirely of shares in VF. So the assets totaled 3 billion. And then the stock unraveled, losing about 80% by year-end 2023. Okay, so back in 2000, so there's another example. Cisco Systems was the NVIDIA of the area, the giant whose routers and other hardware would build the backbone of the booming World Wide Web. On March 27, 2000, Cisco surpassed Microsoft to become the world's most valuable company. At that point, it had a total market value of 500 billion, and the stock hit what was then an all-time high of $80. More than a quarter of a century later, so that's now, that's still Cisco's all-time high. The stock remains more than 20% below where it stood 25 years ago. No wonder in early 2000, investors paid nearly 190 times Cisco's previous 12 months of earnings. Yeah, so the PE ratio, we also talked about PE ratio in the first case. So you kind of see prior to the 2001 dot-com burst how large of valuations a few stocks had. Doubling down on the stock when it's at its peak is an especially bad idea because remarkably few companies turn out to be long-term winners. Of the more than 28,000 stocks whose returns can be tracked between 1926 and 2022, nearly 60%, so it's a majority of all single stocks, earned less than US Treasury bills over their full histories. So that's kind of interesting. According to research by Henrik Bessember, a finance professor in Arizona State. All the stock market's excess return over cash has come from fewer than 4% of the companies. So that's also interesting, right? It's kind of something we also have observed over the past few years, that there are a few stocks within the S&P 500 who are driving the performance, basically. So that's really something which we have seen over the past 100 years. So that's really interesting, I think. Keep that as a rule of thumb in mind. So how does this connect? So we've seen there's an equity risk premium. According to the CAPM, it's paid if either the market is risk averse and or market risk is rising, with this formula coming from these Markowitz investors inside the CAPM, that the market expected return is risk aversion times risk premium. If you want to invest in the market, you hold a well-diversified portfolio. And now the interesting thought here is, or observation, that only 4% of all available companies do indeed beat cash over the long term. Well, it's just one number, so every empirical study has a counter study, but still it's an interesting point to take away with. So if you are as good as a stock picker as Warren Buffett, you absolutely should concentrate only on only a handful of companies. Yeah, that's something also to keep in mind. If you hold a well-diversified portfolio, you will earn the beta, so which is fine for most of investors, but for the asset/hedge funds, they want to produce alpha based on skill. So naturally, to them, they would have to hold a non-diversified portfolio. So they would have to do stock picking and ex ante find the outperformers. And I've mentioned it also in the past. Based on research, the evidence is it's very difficult to consistently pick the winners. Okay, and yes, if you're a brilliant as a CEO like Jensen Huang, you should bet big on yourself and on your company. Okay, the rest of us should diversify, especially when it seems like a bad idea. Goes back to what I said in the Eng book, for example. He shows on a case study and argues that you should always, let's say, once a year, go diversify back to your strategic portfolio weights that you've computed, and doing that, he argues, is like, if I'm not mistaken, being short volatility. But that's something you could double check back in the book, or I bring the book next time if you're interested in that. And kind of imagine you have this NVIDIA stock. It kind of feels really bad to cut it back, right? And that's really what the article says. Okay, so the bigger your recent gain and the more counterintuitive diversification feels, the more vital it will turn out to be. Well, that's just the opinion of it, but it's wanted to share that. And then the other articles I do shorter. There was also an article about Apple could keep falling. So the stock on Apple has been falling over the past weeks. Here's the share price as a multiple of projected earnings. So usually we saw that also in the case. There's the IBIS. It's a database where professionals on Wall Street and academia make forecasts anonymously about where will be the earnings of a firm. So you take the earnings over the next 12 months and take today's price divided by that. Yeah? So you get the PE ratio. Here the average has been around 27, and you see it kind of fluctuates across time. So right now it's at the 5-year average. That's what it says. And so why is it falling? We know the value is determined based on expected cash flows divided by the discount rate. And here it's about expected dividends, basically expected cash flows. So if you are an Apple shareholder, you better settle in for a longer, uncomfortable ride. Apple's share price took another tumble on Friday after Trump threatened to impose a 25% tariff on any iPhones made overseas. Yeah, so if that comes true, then of course your expected revenues of Apple are going to drop, and since the price is expected cash flow divided by discount rate, also the asset prices would drop. Yeah? So that kind of also goes along with what we've covered. This is part of his push to have all iPhones sold in the US made also in the US. Okay. So they talk of more downside is possible. Of course, they also don't know. Yeah. So if Trump's I think this is what I wanted to mention here. Then. Okay, there are also an interesting thing. It's about chip makers face sovereign AI. So the first article was about NVIDIA, and here I think is also an interesting thing. First of all, here you see share price performance year to date. So you start in January 1st. They normalized the price here to be, so most likely it's the return in percent. Yeah, so this would be the return. Most likely the cumulative return. And what you see, you have kind of firms, NVIDIA, AMD, Broadcom, who are in the same sector, have a similar business model. So you also see they have a high correlation in the terms of return. If you connect back to class, within the CAP-M, we would capture that. Most likely they have a very similar beta. And that's kind of what we see here. So what else do we get out of that? Here, other countries. So you've kind of followed the news that the US is having an extra investment in AI technologies, in AI infrastructure, and you see kind of when you ask yourself what's the driver behind the performance of NVIDIA and others, is that, I mean, one part of the performance are that the big tech companies are building up their AI infrastructure. And now for NVIDIA and other companies in that sector, there's a diversification now happening because you have more and more demand of countries, and that's what the article talks about when it talks about sovereign AI, so that countries, or also called sovereign, are building up, create their own infrastructure investment package, like the US. So here they talk about Saudi Arabia. Other countries want into the action in the big way. Saudi Arabia recently struck a deal to buy large amounts of NVIDIA AI chips for local infrastructure projects. And NVIDIA has described India as a major customer as well. Okay, here's what I say. Every country has their own telco. So kind of what's going to happen is that all countries who have excess cash, let's say, extra investments, are likely to build up their own AI infrastructure, which will support these firms who provide these AI chips further. Okay, so that is what and here's what it said. Sovereign AI nicely complements commercial cloud investments. Okay. And the last thing, or was that the last thing? Oh, I see. So this was the last thing I wanted to mention. Any thoughts, comments, or questions regarding to anything I've presented in the past lectures, or as it relates to what I've shown in this Wall Street Journal excerpt? Now, if that's not the case, then let's continue with today's lecture. So today it will be about risk management. So risk in our class today will be the variance of future returns. Yeah? You can also think about the standard deviation of future returns, since that is simply the square root of the variance. So it's a deterministic transformation, so the underlying information is unchanged. We also call that in finance volatility. And in order to manage risk, we first need to measure risk. And this is kind of the focus of today's lecture, how to measure risk. You kind of already know, if you have a time series, you can take the sample variance or also then the sample covariance across different assets, and that gives you one estimator for risk, but it's an unconditional estimator, right? It's unconditionally across your full sample. We kind of saw in the Apple example recently how the PE ratio moves across an average of 26. So 26 was like the unconditional average across the last 5 years. But what we would want to have is it's a conditional forecast. So I would like to know today what's the variance of, let's say, the Apple return from today to tomorrow. I'd also would like to know what is the variance from today to in 2 days from now. And in addition, the frequency doesn't matter so much. So if I'm a high frequency trader or I'm writing an algorithm for that, I would want that in that current second, I want my forecast for what's variance over the next second or the next millisecond. Yeah? So in that sense, frequency doesn't matter. If we have data of different frequencies, we can also compute variance estimates of different frequencies. Okay, so to structure today's lecture, we will first talk about scenario analysis using an example, so you get a picture in mind of what scenario analysis is all about. Then we talk about value at risk, maybe the, or at least one of the most important risk metrics used in industry. And then I show you how you can compute a variance forecast using the GARCH in Python. And you've seen that or something related already during the tutorial in the past, so that would be a nice refresher. And then we move on and we talk about how to use a specific filtering technique, the Kalman filter. So we go through the analytics and then also the Python. So to give some context, the scenario analysis is really of interest to industry. We once were approached by Eurex Clearing. They are kind of, imagine one student in the room is selling an asset, so maybe some derivative which is not traded on the exchange, and someone else in the room wants to buy it. Now maybe you know each other, then you trust each other, but if you don't know each other, you know that there's a trust issue here. So what you want in the middle is a clearing firm, and for example, Eurex also has their own clearing firm, which means they would want to be a counter or the party in the middle to ensure that if the student is not fulfilling the obligations, then the other student shouldn't mind, because the exchange in the middle would cover that. But on the other hand, then the exchange needs to quantify what's the likelihood that a counterparty is not going to fulfill its financial obligations. And if that likelihood rises, then then the counterparty needs to post more collateral. That's maybe what you've heard about. And one tool they're using is the scenario analysis. So we once had a master thesis where for all tradable products on Eurex, because you can think about that the customers would naturally trade something which you can trade at Deutsche Börse, so be it in the spot market, so that would be etc., or be it in the futures and option markets, that would be at Eurex. And since we had at that point in time the time series of all end of day prices for all the assets, we had a student in the master thesis constructing such a scenario tool. So this was a big data project, and I mentioned that for you to really give you this anecdote on how industry is thinking. What industry wanted was, they have their own scenario tool, which is called Prism, but it's a black box tool. So there was one department who wanted their own smaller device, which is kind of white box. And what the student constructed was such a scenario tool, which could really answer questions like, if the DAX drops by 10% and option implied volatility goes up by 20%, what happens to, and then any type of assets you could invest into. That's really the idea of a scenario analysis. You are building, or you're defining exogenously a few scenarios, and then you want to see how would your portfolio, how would the dollar or the euro value of the portfolio develop as this shock arises. So that is what we are going to start to do here. So I have a few punchlines for you. So that scenario analysis is going to define a number of scenarios. So I just gave you one scenario, where in each scenario, various risk factors are assumed to have moved by some fixed amounts. So in the example I gave, one risk factor was the market, so approximated by the DAX. Another risk factor was volatility, approximated by what I said, the option implied volatility. In general, you will have many risk factors. In general, you also don't know what the scenarios are that you are tested against, because it's a tool. But the tool should have an interface that makes it for, let's say, the CEO or the chief risk manager of a firm easy to access, because they will not go into the code and they will not want to use a technical language, but they will really use things like I've just said, the DAX drops by 10%, and then inside the scenario tool, the way it's coded up, you want to make sure that then the math is correct. And the student did very good work on that one. Good. What about this fixed amount? Now, usually the scenario analysis is used, it's also called stress testing, at least at Eurex it was tested that way. You kind of just want to make sure if there are outliers happening, that you have sufficient collateral in that the traders or the investors are posting, and that's why you are asking at the end for scenarios which are realistic but stressful. We have already seen some time series of returns, so we've seen in stress times we have easily a 10 standard deviation move in the underlying. So that would be, for example, one. I said DAX drops by 10%. Anyone remembers what's the daily volatility of an aggregate index like the DAX per day, roughly? We had a number once, maybe 1.2%. So let's be generous. Generous 1%. So if you go for a 10% drop, it's really like a 10 standard deviation event. Yeah, so something we really see in COVID, 2008 financial crisis, and the like. Okay, so here's just a summary. Potential scenario could be all stock prices fall by 10% and all implied volatilities increase by 5%. Another scenario could be as above, but then in addition, you have that the term structure of volatility is going to steepen. Yeah? As we move through the course, we get more acquainted also to information in options. So we will see that there are options with different maturities traded, so we can infer the volatility priced in these options. And what traders, risk managers want to know is also how does such a volatility curve steepen, or if a crash comes, then it might steepen or it might drop. So from that you see the scenarios can be really vast. Now we just have 3 parts of the scenario, but in reality it just could be really big. Okay, and in that setting, risk can be defined, so therefore it needs to be clear how is risk defined here, and in that scenario here it would be defined as the maximum loss over such a considered scenario. Right? So it's kind of how much are we expected to lose if the following happens. And you see what you want to do is you want to build a model that maps these, or that maps risk factors into the value of a portfolio. And the other thing you want to do is you need to make sure that these scenarios, as they are defined, let's say by the chief risk officer of a firm, then maps into the risk factors you're using. Because internally, inside the code, we work with our risk factors, while the risk officer works with what they are working with. So it's like stock prices, volatilities, and the like. And therefore, you will have, if different analytics firms work on such a solution, you will have different forms of implementation, because there is no clearly defined set of risk factors that one is using, but you would start with what's kind of market risk. Yeah? So therefore you think about overall market movements, then you think about firm-specific risk, that's kind of the epsilon in the regression, and that's how you try to build up such a model internally. We are not going this route, this takes far too much time, but I wanted to connect back to what we have used. And for example, the way the student has solved that is kind of similar. You know, if you have like 5,000 stocks to invest, in order to get risk factors, you could do principal component analysis. So what are the most important risk factors there? So that's what we did. We also wanted to always map back, that we could always, if someone talks about a specific stock or the index, that we could always rotate our risk factors back into these specific stocks. So that's also kind of what we've used. And then we kind of used risk factors in terms of PCAs for the stocks, I've mentioned that, and we did the same then for options. So we computed implied volatilities of options that we haven't yet talked about in the course. It's something to come next week, so therefore I tried to make a few mentionings of that already today to warm you up. So you could do the same for options. You either work with option returns or you translate them into volatilities. It's less noisy, less volatile, and then you also do principal component analyses on these volatilities. So it's the same idea, basically, reduce the factor structure. And doing so, you already capture all the risks in the spot market in equity and all the risks in the option market. Just with that simple thought of principal component analysis. Now, the advantage is with the scenario analysis, you do not need to estimate probabilities. Because the outside person, the risk manager, is constructing a scenario, and then we just need to know if that happens, what's the impact on the portfolio. But we don't have to quantify what's the probability of that thing to happen. It doesn't matter. So in that sense, it's kind of easier. But the way we've done it with the scenario tool was we still then computed a density and mapped the density into, or mapped how different risk factors map into the final density. Okay, but in a typical scenario, you don't do that. But of course, we had Markowitz in mind, and we wanted to have a density. Okay, so here's a copy I took from somewhere. It shows you an example. So that's a profit and loss for an option portfolio on the S&P 500. So this is for an index option under stresses to underlying and implied vol. So the idea is the asset you here care about is an S&P 500 option. So the option gives you the right to either buy the S&P in the future, that's a call option, or to sell the S&P 500 in the future for a specified price, that would be a put option. And here the point is that you identify the risk factors for an option. It's more straightforward to think about. There are two risk factors here. It's the underlying itself, because it's an option on a stock here on the S&P. So if the S&P 500 moves, the value of the option will move. And therefore we have here on, if you want, on the y-axis, we have different scenarios, like a minus 20% drop in the S&P 500, a minus 10% drop, or here a 20% increase, 10% increase, and everything in between. Now, a second risk factor for an option is volatility itself. So here we also have predefined stresses for volatility, and the minus 10 would be that the option implied volatility is dropping by 10 percentage points. Or here it goes up by 10 percentage points. So that gives you a matrix, and I've highlighted here a green bucket. So the green bucket gives 8,419. So it would say that if implied volatility is rising by 5%, while at the same time the S&P 500 drops by 20%, then the option on this S&P 500 index would go up by 8.419 million. Where are these numbers coming from is a question that comes up. Well, it depends on the underlying model you have, which here I'm not displaying. I just wanted to display kind of the output that such a risk manager or a risk CEO will see once they trust the stress tool. Then this is the output of their tool. So the manager then defines these stressful periods, like the one I did. There are here two risk factors, so they have to define how both risk factors have changed, and then they would see here they would have a gain of 8 million in their portfolio. Good. Now let's talk about it a little bit. We will not work with a scenario tool, not in a problem set or the like, but I just wanted to add that since it's of high relevance in industry. So let's talk about or think about some potential pitfalls, something to think about if you build such a tool. First thing is you need to identify the risk factors. Now, identifying risk factor for single assets, here it says it's pretty clear. Like in the option example, it's the option on a stock, so you would always have the stock and the volatility of the stock as your risk factors. Or I've mentioned for the Deutsche Börse case, we had all the etc. products, all the options from Eurex. So we also used PCA separately for option vol and for the stocks. That's how we identified risk factors. So here one should think about that. What could happen is that you might have a risk factor which is not important for single stocks, yet in a portfolio it might become important. So that might be something to think about, since scenario tools are usually applied to the portfolio level. So it could be something which is, as it says here, of secondary importance on a single factor, might become first order importance on the portfolio. And therefore the risk factors might depend on the portfolio rather than on the asset class. Well, in the way we've done that for the case I've mentioned, we didn't encounter that. We were working on a single asset basis, and then just took, if we had like 5,000 stocks, we took as many PCs as we needed to explain 95% of the variations in these 5,000 stocks. So that was fine, but I took this here from some other resource. So these are not my pitfalls, but more generally speaking, what people might consider to be pitfalls. Okay. And interestingly, the way Eurex did that, they did not do that across assets. They were focusing more on one asset class at a time, while we, using this PCA approach, we were completely agnostic about the name of an asset class. We just wanted to know, is that traded in the spot market? So is the underlying risk factor just the underlying, or is it also volatility? And then just use PCA for each, and this worked very well. The next potential pitfall or difficulty is to identify reasonable shifts to the risk factors. Well, that also we didn't have to do as the developers. That's what from Eurex, they gave us a few examples which helped us to then write down a model such that we could address that. Like what happens if the DAX drops by X and vol goes up by X, interest rates go up by blah, you know? So we kind of knew the risk factors that industry wants to work with. But in generally, if you build a system from scratch, you would also have to think about, once you have your risk factors, what are these plausible shifts? Especially for risk factors which are less transparent, so meaning for risk factors for which you do not have sufficient observations. Because if you have a time series for a risk factor and it's a long time series, I could figure out what's the max that happened, the min that happened, what's the standard deviation, skewness, kurtosis. But I don't care so much now that I think about skewness, kurtosis. I just really want to know what was the worst that it happened. Yeah? And if it happened twice, even better. So I know it's not an outlier. What just happened once there. And a typical tool to use is like PCA. That's what we have been using as well. You can use extreme value theory, time series methods. So that's what we did use with common sense. Yeah, kind of common sense is if you saw the max drop you once had was 10%, so it's not common sense to work with 50%. Yeah, so. In the regulation, that's also what I've learned. There are firms like this Eurex Clearing, they have regulation, and the regulation kind of says it must be extreme but realistic stresses that you apply to the system. Yeah? Extreme but realistic. It's exactly the same thing. So if you have a time series, a longer one, you see what is realistic but extreme. But on the other hand, think about, for example, correlation. We know that in a crisis, correlation moves towards 1 because everything is dropping on average. And if you compute correlation based on just time series data, such big crashes only happened in very few occasions. So you don't really pick up what is the worst correlation. You could say it's just 1.0. Yeah, but maybe there's another way to mathematically compute it better, and we kind of struggled with that. And so did the industry partner, because if you don't observe something, it's difficult to estimate. And then you really might use common sense, like, okay, I just assume if it's such a bad stress we are looking at right now, like a 10 standard deviation move in the underlying, in the market, then let's just assume correlations in that moment are also converging towards 1. Because if we are in a crash, usually everything drops. Not fixed income, that's the hedge. We talked about that also, at least in the Economist article. Interest rates, bonds, or think about Markowitz, flight to safety. So if risk is rising, what's the Markowitz investor is doing? He deleverages, so he reduces on the capital allocation line his equity exposure and moves into the risk-free rate. which means that treasury bill prices would rise because of the increase in demand. Yeah, so you have a negative correlation between asset class fixed income and asset class equity, but within equity, usually correlations tend to go to 1 in a stress. So these are things you could build, or you should, or someone, an analytics firm who charges a lot of money for such a tool should build that in. And another pitfall is the risk manager needs to understand what scenarios are plausible and which not. Yeah, that's why I refer to regulation, which says it must be extreme but realistic. Okay, here for instance, in a crisis, there's a drop in the underlying. It's associated with a rise in implied volatility, because that's usually what we have. Prices drop, volatility rises. So that you can build in. And with that kind of knowledge, if you go back to the previous one, you see that a drop in the underlying is associated with a rise in volatility. That's an empirical fact, empirical observation. So therefore, you know this part of the quadrant here, it's not realistic. So you can just cross it out, or it's completely unrealistic that the market drops by 20%, and at the same time, uncertainty also drops. This is not possible. I mean, there's a probability that this happens, but the stress tester would rarely test that because it never happened. And then you think about theory. Is there a reason why this should ever happen? Kind of, you have a drop in the market, everyone gets scared, and at the same time, volatility is shrinking. It just makes no sense. Yeah? So therefore, using this common sense, you kind of know this is something on the right side which you should consider. Okay, now let's move on then to value at risk. So the value at risk is a quantity which is computed by financial institutions because they are forced to by regulation. So it's really a measure, a single number to assess how much could you potentially lose. Yeah, so therefore we have it also new in the program. So it's based on the loss distribution of a portfolio, because we're looking at the risk, so it's the left tail risk, so it's about the loss and what is the worst loss that could happen in a specific time frame and with a specific probability. So that's kind of what it will be. If we work with a value at risk and we have a portfolio, then we would think about that the diversification which happens inside the portfolio is then taken care of in terms of the value at risk. So if something's less risky, there will be less value at risk of that portfolio. One advantage of value at risk is you get a dollar number. Yeah? You will get my value at risk is, let's say, 10 million. So you then need to know it's going to come. What's the probability? Because I haven't stated, I just said my value at risk, but I should then maybe say my 5% value at risk. So it's like in the 5% worst cases, what would I lose? And if it's 10 million, then I would lose 10 million in the 5% worst cases. So which case do we have tomorrow? I don't know, but at least I know, historically speaking, if it's a day that was the 5% worst day in my history, then I would lose these 10 million. Yeah? So I can kind of work with that. And if I have now a derivatives portfolio, or I have an equity portfolio, or I have a real estate portfolio, if something has a valued risk of 20 million, then I know I can lose twice as much than on the other portfolio. So I can really use these numbers across different asset classes, across different investments, because it's a dollar loss that could occur. Yeah? Okay. Now, given that it's based on the loss distribution, I would have to estimate the loss distribution. Yeah? So that might be challenging, because estimating density functions is a tricky business. It becomes even more tricky if I lack historical data, or also what we have in finance, we have non-stationarity. So it's kind of the environment that we are in Just think back about the Wall Street articles. Friday, Trump again saying something on Apple, affects the stock on Apple. So it's very agile and dynamic, the environment we are in. So another term is non-stationarity. So therefore, you might have long data, but the regime you're currently in is very new. And therefore, it's like having no data at all. Because the old data doesn't help you much. It's a different regime. It's difficult. Yeah, but that's kind of what we are facing. Then densities are usually estimated using models. So if you take a poor model choice, you also will have a poor density estimate. So that is also something to have in mind. Okay, so let xt be risk factor changes. Yeah, so as of time t, you have your risk factors. You can compute what is the change in these risk factors. I call it xt. And let's assume they are drawn from a stationary distribution fx. Now we have two definitions for loss distribution. One is the unconditional loss distribution. So that's something across the full sample. It's like an average. Yeah, so you have like an average density. So it says the unconditional loss distribution is the distribution of losses in t plus 1, so next period, given time t composition of the portfolio. So it means the portfolio is chosen today, and then in t plus 1, I have realized payoffs, and therefore I have realized losses. Okay, and so unconditional loss distribution is the distribution of LT plus 1 given portfolio weights in WT, assuming the conditional, cumulative density function of the underlying risk factors is driven by fx. Yeah, so maybe think back to the scenario analysis. You have an option on the S&P 500. The underlying risk factors would be the S&P 500 itself, and it would be the volatility of the S&P 500, something we estimate later today. And these two risk factors move across time according to the density fx. So I think that's a very general thought on how we would model the value of an underlying, or here the value of a portfolio, figure out the risk factors, find the density of the risk factors, and then compute the loss distribution of something that depends on the risk factors. Here I'm highlighting this unconditional density. It may and most likely will look very different than if you compute a conditional density. So let's first check definition 2 on what is a conditional density. Now, a conditional loss distribution is the distribution also of LT plus 1, also given the portfolio weights as of time t, but the difference is that we are then conditioning on only FT information. Yeah, so you can in general think about a conditional forecast always conditions on today's information to make a forecast for the future. While an unconditional forecast is kind of integrating out that we are conditioning on today's information. It just says, let's assume we have no information. But of course, you had to estimate the parameters of a density. So it's like if you say the sample variance is an unconditional variance estimator. I've used that language already today. Yeah? Because if the variance is, let's say the volatility, so the standard deviation was 20% unconditional, it just means on average, vol is 20%. Okay. But the question is then, but is that a good forecast for tomorrow? Because let's assume there was a bomb dropping an hour ago. Of course, volatility will not be just 20%. It will not be the average vol, but it will contain information that this bombshell dropped, so something major happened, volatility will spike up. But for the latter to be computable, you really have to compute these one step ahead predictions of volatility and also of the full density. And that is something we will do today using the GARCH and also the Kalman filter. So, okay. Now, if you do these conditional forecasts, you usually have to specify what's the time horizon in your forecast. So for value at risk, institutions have the obligation to compute such forecast on a 1 day, 3 day, 5 day, up to 10 day horizon. Yeah, so that's what I've been specifying here. Good. Maybe one thing, if you want to connect back in the Python tutorial, you have seen maximum likelihood. And you might have noticed that we are learning the parameters using the joint likelihood, the joint log likelihood. And that has, if we talk about the joint likelihood, that has been the product of the one step ahead likelihoods. Yeah, so what's the probability of the second observation conditional on the first? So these are conditional densities. And then you are multiplying by what's the probability of the very first observation. And there you condition on F0, so you have no information at all. So this first density was the unconditional density, while all the others were conditional. So you condition on information that you have observed in the previous period. Good. So in itself, it's very natural to talk about conditional and unconditional, and I wanted to spend some time on that. So if there's any question, just let me know, right? Otherwise, I move on. So value at risk is the most widely used risk measure in industry. It has some weaknesses, but by regulation, it is mandatory for financial institutions to compute that. They've been really being routinely reported also to shareholders, to investors. You have a forecast horizon, I've mentioned that, 1 day up to 10 days. And L would represent the loss on a portfolio over this time horizon delta. Now, I just remember a friend from the PhD, from my PhD program, worked at a big bank in another country, and there he or she worked in kind of assessing the risk of the entire bank, which is also, that's a big task. So you want to know how much would the bank lose in very bad scenarios. So you have really to average across all the investments that a bank has. For that, you also work with a value at risk. So here's a definition now for the value at risk. So let F be from the real to 0, 1. So that is our density. 0, 1 are the probabilities. So that's an arbitrary cumulative density function. Then the alpha element 0, 1 is the alpha quantile of F, which is defined as. So Q alpha of F is the alpha. Maybe I go to the picture first. So let's say we have a Gaussian CDF. So this is kind of what it would look like, this shape here. So it's a cumulative density function. It starts in 0 for something which is very unlikely to happen, like here a -4 standard deviation event. And then it's monotonically rising at x-axis being 0. This is exactly CDF being 50% because it's a symmetric density, the Gauss. And then you see if you get to something in the right tail, which is completely unlikely, you are converging towards 1 on the y-axis, yeah, probability of 1. And now what this alpha quantile represents is that there's a 5% probability for the probability mass to the left of this 1.645. Yeah? So therefore, the alpha quantile is that the 5% quantile of the Gaussian would be the minus 1.645 on a Gaussian which is 0, 1 normalized. Yeah, so it's like a minus 1.6 standard deviation event would correspond to the 5% quantile. And what we want to compute with the value at risk is basically what are we going to lose if such an event is going to happen. So it's not yet the value at risk definition, it's the definition of the quantile. So Q alpha of F will be the smallest x such that f of x is larger or equal to the alpha. Yeah, so that quantile here is found as the minimum normalized return, such that to the left of it there is a probability mass of 5%. Yeah, so it could get even worse, but if you say what's the 5% worst thing that could happen, here it would be minus 1.645 standard deviation move to the left. So if f is continuous and strictly increasing, because depending on the density you are working with, f might not be strictly increasing, but it might have periods where it's kind of steady, flat. But if it's not, if it's really monotonically increasing, then you find the Q alpha of f by taking the inverse of the CDF evaluated at the alpha that you want. So from that you see that you need to know the f, which is the CDF. And so you have to estimate that density. Good. Now let's come to the value at risk. I added a few pictures which I found on the web, so maybe it's of use for you, I hope so. But I just focus on the definition here. So let alpha element 01 be some fixed confidence level. Then the value at risk of the portfolio loss at the confidence level alpha is given by a value at risk, that's the notation, VAR, alpha on the bottom here as an index, and that is defined to be the alpha quantile of the loss distribution. Yeah, so you need to compute a loss distribution and then determine what is the alpha quantile. Alpha is usually taken to be 5%, but could also be 1% in a specific setting. Okay. Okay, so let's have two examples. So let's say we have a Gaussian distribution for the loss. So we know that the loss is distributed according to a normal, so a Gauss variable. The center is characterized by mu, and it's known. The variance is sigma square, it's also known. Then the value at risk to the alpha quantile can be computed as the expectation plus volatility sigma times the inverse of the Gaussian CDF evaluated at that alpha. Yeah, so if you look at that, phi to the minus 1 alpha, and you think back to this picture here, where the Q alpha f is the inverse of the density, and I said here the solution was minus 1.6 standard deviations. So you really see what the value at risk captures. It kind of captures what's the expected change in my portfolio, that's the mu, okay, great. But then you have a specific standard deviation shock to it, and here it's the phi minus 1 at the alpha, right? So that is, in the Gauss example, we had 5% alpha. The phi to the minus 1 alpha would be minus 1.645. So therefore, your portfolio is expected to change by mu, but then at the same time, you have a minus 1.645 standard deviation event. And this will give you then what is the value at risk at this 5% level. So analytically already, here I want to highlight, you see that the value at risk depends strongly on volatility. So if your volatility estimate is rising, so does your value at risk. It kind of also tells you, you see, because the value at risk is simply a deterministic function of what we see on the right. Now mu, difficult to predict. So for my first order thinking, I think there's not much time variation coming from the mu. Today we talk about how to estimate sigma, so there will be a lot of time variation in the sigma. So my point is that the time variation we observe in the sigma will then translate into the time variation of your value at risk. Yeah, you should kind of anticipate that the value at risk time series shares a high correlation with the underlying volatility. So that is something I have also observed in our database for the option implied value at risk. And here I want therefore to highlight, if we work with the Gaussian, we have this very transparent white box mapping between the inputs of the density and the value at risk. And I just wanted to make this case that you really see clearly how volatility is a first order risk factor for the value at risk. So if something is wrong with your value at risk, it's not as accurate as you or someone else wanted it to be, it will likely mean that your volatility forecast is not good enough. Okay. Now, if you want to work with the T distribution, so T is a bit like a Gauss, but it has fatter tails. Then if L is a T with these three input parameters, nu, mu, and sigma square, so that the loss minus expectation divided by volatility, so the kind of the normalized loss, has a T distribution with V equal larger than 2 degrees of freedom, then the value at risk is determined in a similar way. What's the expected change to my loss if nothing happens, and then plus, and then again you're inverting here the T density at the alpha quantile, and then you're multiplying that by your current volatility forecast. So again, highlights how volatility directly maps back into your value at risk. Good. Now, what's the weakness of these value at risks? Well, it's the strength of a value at risk to really give you $1 amount at hand, which you know I can lose 10 million in 5% of the worst case scenario. But on the other hand, you know that the true loss distribution is a full distribution, and characterizing a distribution by just one number, of course, has a weakness, since significant other information is lost. So one way to overcome that is kind of to discretize the left tail part of your density, and one way you could do that is to report the value at risk for different quantiles. Let's say 5%, 1%, 0.1, 0.001. So really go deep, deep, deep into the tails. Because from a Gaussian, we anticipate, if I go back, for a Gaussian, you anticipate the loss in the deep tails to decay rather quickly, but in reality, it might not be the case, right? In reality, you might have here an extra bump showing up really down there. So even without knowing the density explicitly, you could reapply but what means not knowing the density? You have to know the density for the inversion. So anyway, you need to know the density, but you can compute several value at risks, like taking discretizing here this left tail by a few values like 5%, 1%, 0.1. Another thing is weakness is model risk. So far, all the visualization has been with the Gaussian. So already you might have thought, if I work with a Gaussian, I might underestimate tail risk, which indeed is the case. So value at risk has model risk attached to it. I've just mentioned that if you have a Gaussian or a Gaussian model, you have a specific decay in the tails, which might not be the true one. So therefore you might underestimate the true risks. So it could really easily happen you underestimate the value at risk. What we had been doing in this master thesis was we did not work with the Gaussian, but we worked like with a bootstrap. So we kind of tried to bootstrap the loss density based on past data. I think this is to be preferred than working with a Gaussian density. Another thing we compared it with was we just used a density which has time-varying volatility and which also had jumps, so sudden moves in the return and in the volatility. So we kind of tried different things, and the tool offered the user to decide themselves. They want to use this parametric density, but which incorporates for non-Gaussian moves in the tails, or to use the bootstrap density. Okay, and another thing for the weakness in value at risk, it's not what's called sub-additive. So it means, let's say L consists of two portfolios, L1, L2. So yeah, maybe this is equity loss, this is the bond loss, and both together give you your portfolio loss. So that will be the total loss. So if you now compute the alpha quantile of your loss density, then that will be larger than the sum of the individual ones. And that is something you might not want, but you have to buy it. It's innate, because the reason is, if you can lose 10 million in equity and you can use another 10 million in the bond, if you put them together by the plus, then you have diversification happening. So you would want that the value at risk is falling in that scenario, but it could be even rising. There have been many research papers in the mid-1990s, late 1990s on that and how to overcome that and so on. We're not going into that. I just wanted to have this one slide that collects these three potential weaknesses. Yeah? But the bottom line is, value at risk is the most often used risk metric for financial institutions to know how much can I lose. Good. Now let's move on towards the idea, how do I get the volatility estimate? So by now we have seen, coming from the value at risk, I need an estimator for volatility, and that needs to be rather accurate. So first I want to motivate you to have a look. There's something called VLab at NYU. You can just, at least last time I checked, which you see was December 11, 2024, it was open for the public. So this is entertained by, I don't know right now, by Bob Engel. He got the Nobel Prize Financial Economics for the GARCH modeling. So he has a lab there. And you see, for example, here what I did is I wanted to get for the S&P 500 index, so I could select which asset. So I took S&P 500. I could select, I want a volatility analysis, and I could select what's the model. We are talking about that today, but you have seen it in the Python focus session, so you will see it again today. So here I'm saying, give me a GARCH analysis. I could even specify which type of GARCH. So this is a GJR GARCH, so it also captures skewness, but if we don't have the formulas in the lecture notes, then we don't need that for this bachelor's class, but just that's why I've highlighted that. If you Google that or Wikipedia, the like, this is a term that will show up, what it's like, but basically it allows you to capture skewness in your estimation. It's like a normal GARCH. I'm just saying it. It's a normal GARCH. We see what will be a normal GARCH in 5 minutes. And then we add another parameter that captures this asynchronity, that if the return has been negative yesterday, there's a tendency for the variance to be higher. Yeah, this is like the asymmetry which captures left skewness. Okay, and then you get a time series. Here I wanted to have a time series 1990 to 2024. So let's have a look maybe at that. I kind of like these pictures here. So first in blue you have the, or maybe start in green, you have the price of the S&P. Yeah? Price looks rather smooth. So it looks like investing is easy. It's just going up. Now for statistical analysis, I've mentioned that. I re-highlight. The price is non-stationary. So for statistical analysis, we need to work with a stationary time series. That would be the return. And now the return doesn't look that pleasant anymore. So it's just wobbling, but we see volatility clustering clearly. There are some periods where it wobbles stronger than in others. So this is one cluster, another cluster, here's another cluster, another cluster. Just also, if you zoom out, it looks like a speech time series of different amplitudes related to my voice. Yeah? Therefore, you see why tools like the Kalman filter we apply today is coming also from signal processing, signal extraction. You see why engineers, mathematicians like to work in finance. You use very similar tools once you go to the quant side. Good. And what do we have now? So this is kind of what we observe, blue and green. And what we want to get, but it's unobserved, is red. Red is the annualized volatility. We basically want, from each blue dot, we want to extract out of that the second moment. Yeah? And you see it's difficult from a realized random variable to extract a conditional second moment. For that, we would need a model. The model gives some structure and allows us, based on the structure, to make a prediction. If the model is correct, the prediction is correct. If the model is completely wrong, the prediction is also completely wrong. It's a model-based forecast. But let's just enjoy what the time series here looks like. On the y-axis, we have annualized in percent. So we know on average 20% vol. Yeah, so here is kind of the average on that line. Seems to make sense. We are here below average in the early 2000s. Here we are above average. Okay, here above average. Good. And maybe let's go to one of these ellipses which I did draw in. Here you see. Volatility has spiked, so it looks like a little jump which happened because it's a very sudden move in volatility. So for that, you would, if you want to capture that, okay, let's just observe it first. So we have this jump in volatility. This is 1998, so there was a financial crisis in 1998. There was the Russian crisis, Asian crisis, LTCM. I've mentioned that already once. Failed, so this was in 1998. Yeah. Then you have here 2001, like the September 11. Yeah, maybe I went here via 2001. You see, I might have made an error. This looks like a bigger spike here, but I just went 2001. So I thought this is September 11. If that's the case, you see there wasn't too much in terms of volatility. Then you have here volatility spiking to 80%. Yeah, go up, goes down, goes up again. 2008, fourth quarter, so that's the financial crisis. So let's use that as our showcase. You see the prices are dropping here, typical for a recession. At the same time, we have returns which are all over the place. So volatility is high, and now we extract volatility using the GARCH, and we see, yes, indeed. Volatility was high at 80% volatility. Yeah, so 4 times higher than the unconditional estimate. And then it calms down again. And then we had here during COVID, volatility estimate of nearly 110% for the index, which is diversified. Right? And the index on average has half the volatility of a stock. So you could already anticipate if you apply the same analysis to a single stock, the vol might have been, I'm really scared to say 200%, but I've seen it at 160%. And that is based on a tool which we will also work with and that you will also apply in the next problem set. Good. In terms of statistics, let's see what they bring. They bring the closing price, average week vol, so that's like just the time series average of the red time series across the last week. Then minimum vol was 7%, average vol is 18, so like our rule of thumb with 20. Then they have average return, 0.8%, average monthly vol is 11%. Max vol was 108% during COVID. Then vol of vol, that's maybe interesting, you've never heard that maybe, but you see the red is simply a time series. Of course, I can compute the volatility of that time series. Yeah? And then it's just called vol of vol. And then here comes the 1 week prediction. So based on the last observation, which was December 11, I now make a prediction for the next week, next month, next 6 months, next 1 year. And the GARCH will have a parametrization. I'm estimating the parameters, and therefore I can make these predictions moving forward. Yeah? And you see now, I have these predictions, which I could then be using, for example, to compute the valued risk, since, as I've mentioned, vol maps directly into the valued risk. Okay, so coming from this industry example, you kind of get the notion that these GARCH models are heavily used and are the first to go approach. And the more general expression here is GARCH MS. We will see what it stands for. Okay, so let's have a big picture. I've mentioned many things, but here now a summary. Typically, you're going to observe a time series of returns. What you want is the time series of the second moments, which is the variance of returns. But that thing is unobserved. Yeah, we do not observe moments of a density, always just the realization, which is a big pity because we care for the moments. And we can use the GARCH, so the generalized autoregressive conditional heteroscedasticity models, to back out, or it's also called to infer, different jargon language, to back out these conditional variance time series. And let's see what it looks like. So that's another example. So again, just on having big picture here, let's assume we observe the stock return of Adidas on a daily basis. This is what it looks like from 2000 to 2019, May. So again, we know maybe 1.5% volatility on a day. So here we have 15%. So this would be roughly like a 10 standard deviation event to the right, to the left. So we see clearly kurtosis in financial returns. Since we have a lot of events above 3 standard deviations, we see volatility clustering clearly. Here's one cluster, here's a cluster, here's a cluster, and here we have a big outlier to the left, even bigger than COVID. Okay, and there's very little, if any, predictability in these realized returns. So to predict the first moment is basically not possible, even with machine learning tools. The time series is just far too noisy, basically. Yeah? There's too little information about a potentially very smooth time series here, which captures the prediction. But what we can do and want to do is we want to compute the volatility of this time series. And here's what it looks like. That's the time series of Adidas volatility. And it looks pretty nice, yeah, not perfectly nice because I have jumps over here, which I know are difficult to predict forward. These sudden moves, but visually I tend to think about like a moving average. If I put the moving average here, I would really get something which kind of moves like this. So that would be easy to predict, so the overall trend. We also now see vol clustering clearly, that if vol is high, it tends to be high, or if vol is low, like here, it tends to be low. It's rather smooth, but the rather it's comparing it to realized returns. And we also see there are these sudden spikes here. And if I wanted to predict that forward, that will be difficult. That will be difficult because I don't have these spikes too often. Yeah, 1, 2, 3, maybe 4, 5, 6, 7, 8, 9. Just 9 observations. It will be difficult to really get these spikes right in a prediction, and we will not get that. But at least we are extracting the time series of the second moment, and that's all we want to do for now. We also clearly see the financial crisis. Adidas vol roughly 80%. So what was the market? I think was also at 80. So not too much of idiosyncratic risk if I just compare these two numbers. COVID-wise, also Adidas didn't do too badly, 70% vol. So you see that kind of intuition firms are on average have a twice as high vol is true on average, but for these specific crisis periods, it's not, and therefore we need these conditional estimations for volatility to really be sure what is the vol currently, and then to use that to make a prediction. And here I had been using an AR2 GARCH 1.1 model. So let me just double check. Anyways, so I've basically assumed that I can model the mean of the time series using an autoregressive model of second order. Then I get a residual, and that residual is then fit to a GARCH 1.1. And I will have a parameterization of the GARCH coming up. So here, the essentials of a GARCH. Now, keep in mind, at our KIT curriculum, we have a course in statistics which spends several weeks on everything around GARCH estimation. So I just highly recommend to have a look in that course as well. Here I give you what we need for our financial data science applications. So here we assume R is the log return at time t for a portfolio between t minus 1 and t. So what I want to say is R is some return. Here I use a log return, but you could also use a simple return. It doesn't matter. Of course, in the details it does matter, but for my mathematical exposition here, it just doesn't matter. So RT is, I like to think in terms of RT is the realized return in T. It consists of two components. One is a component that was predictable as of t minus 1. So this is my prediction, mu, as of t minus 1. And here's the formal definition. You see, mu t minus 1 is defined to be the expectation of RT conditional on ft minus 1. So the index notation I'm using here follows the convention that the time index highlights when is a variable known / observed. So, and here mu is known as of t minus 1, so I give it a t minus 1. There are other sources, like if you check Wikipedia or also some Python packages, they use a different indexing here, they use mu t. So there are different rules to that, and this is kind of the rule I'm using, which I have in this box. On the other hand, I have an epsilon t, so it highlights it's the realization of a random variable which gets realized only in t. It comes from some distribution which is centered around 0, and it has a variance of sigma square, t minus 1, which also is to say that epsilon t is drawn from a density which is not predictable, mean is 0, and it comes with a variance which I know as of t minus 1. Very typically, here's the formula for the variance. So sigma square t minus 1 is defined to be, sometimes I call that forward-looking variance, although it would be enough just to say variance. But when I say forward-looking, I have this equation here, or this mathematical expression in mind. We always want to compute a forward-looking variance, right? Because ex post, if something has happened, the random variable has been realized, there's no risk anymore, I know what it is. But I don't know what it will be next period. So therefore, what I want to compute is the variance of RT conditional on ft minus 1. So I like to think about t minus 1 is today. So as of today, what is the variance of tomorrow's returns? And that will be exactly the same than the conditional variance of the epsilon. Yeah, you can just plug in the RT is mu t plus 1 plus epsilon t. Maybe I do that on the board. So we have, what is RT? It's okay, and now you just check as of t minus 1, this guy is known, that's why this indexing is really nice. So this is a constant if I condition on t minus 1. So therefore the variance of a constant is not existent, it's 0. And therefore we simply have the variance of epsilon t. Okay. So you clearly see if you want to compute the variance of the return, that variance is driven by the variance of the epsilon. Okay, now in order to parameterize the mu, which we need to do because we need to get an estimator for the residual, and the mu t minus 1 is assumed to be an arma x pqk. So arma is autoregressive moving average. This is this part here. This is the arma part. So you see that we are saying the prediction from t minus 1 to t depends on a constant, plus, and now we have p lags of the realized return, and we also have q lags of the realized prediction errors epsilon. These parameters, theta I, phi I, are unknown, they need to be estimated, but we could do so using OLS, yeah? Because we observe returns on the left, we observe this guy, and we observe, okay, these guys we don't observe, so we would use two-pass regression. That's what we could do. We could estimate the phi approximately by OLS, regressing returns on its lag. That gives us some residuals, and now we take these residuals and regress them on their own lags. This gives us what's called a two-pass estimator. It's not the most efficient one, but these are very good starting values, and then we could run a maximum likelihood estimation, for example, using these as starting values. You might have seen that already in the Python focus session. And then I've also added the X here, which you don't see all the time, but I wanted to highlight. You can also add any other predictor that you observe as of t minus 1. It could be, for example, the dividend yield based on our case number 1. It could be Farmer-French return factors. It could be any other variable you think is useful for prediction. Yeah? As long as it's observed, you just include that. Okay, let's have a break here, and then I continue with the last equation.